In the world of cryptocurrency, where fortunes seem to rise and fall overnight, one harsh reality stands out. Most people who dive in end up losing money not just a little, but often everything they invest. This isn't due to bad luck alone. It's rooted in fundamental misunderstandings about how these markets truly operate. Many enter cryptocurrency with visions of quick wealth. They hear stories of early adopters turning small sums into millions, yet they overlook the survivor's bias in those tales. What they fail to see is the multitude who tried and failed silently. The misconception begins with treating crypto like a lottery ticket. People assume that picking the right asset at the right time is all it takes. But markets don't reward guesswork. They punish impulsivity. Another common error lies in ignoring the psychological traps. Emotions drive decisions more than logic in volatile environments. Fear of missing out, FOMO, pushes buys at peaks, while panic sells at troughs. This cycle repeats, steadily eroding capital. Beyond that, many underestimate the role of market structure. Cryptocurrency isn't a level playing field. Large players, often called whales, manipulate prices through coordinated actions. Retail investors chase shadows, reacting to movements designed to trap them. Information asymmetry compounds the issue. Insiders access data and networks that outsiders lack, while amateurs rely on social media whispers or unverified tips. This leads to asymmetric losses. Now, let's break down the core reasons why losses dominate. First, lack of proper education forms the foundation of failure. People invest without understanding blockchain basics or token economics. They buy into narratives without questioning underlying value. For instance, a surge in price might stem from hype rather than utility. Without discernment, investments become gambles. Second, emotional trading amplifies risks. Markets fluctuate wildly, testing resolve. A sudden drop triggers sales to cut losses, yet recoveries often follow, leaving sellers regretful. Conversely, greed fuels holding through unsustainable booms. Bubbles burst, wiping out gains. Discipline separates winners from the crowd. Third, overleveraging turns small mistakes into catastrophes. Borrowing to amplify positions seems appealing in bull runs, but in downturns, margin calls forced liquidations at the worst moments. This mechanism has ruined countless portfolios. Even moderate leverage multiplies volatility's sting. Fourth, diversification is often misunderstood or ignored. Putting everything into one asset exposes you to total ruin. Spreading across uncorrelated options mitigates risk, but requires strategy. Many chase hot trends instead, concentrating risk. Patterns emerge from herd behavior. When euphoria builds, volumes spike irrationally and contrarian views get drowned out. Recognizing these cycles demands patience. History shows booms followed by prolonged winters, yet newcomers expect perpetual growth. This mismatch breeds disappointment. Psychologically, loss aversion plays a cruel role. People feel losses twice as keenly as gains. This biases toward risky recoveries, compounding errors. Awareness of such biases is crucial. Market behavior reveals predictable traps. Pump and dump schemes lure with artificial rallies, and social proof convinces the unwary. Scrutinizing sudden promotions helps avoid them. Another pattern is chasing yields without assessing risks. High returns often mask Ponzi elements. Sustainable yields come from real economic activity, not endless inflows. Questioning the source preserves capital. Over-reliance on influencers misleads. Many promote for personal gain, not viewer benefit. Independent verification counters this. Timing the market proves futile for most. Attempting to buy low and sell high invites frequent trades, each incurring fees and tax implications that erode edges. A long-term hold, informed by fundamentals, fares better, but patience is tested in turbulent times. Red flags abound for the observant. Unrealistic promises signal danger. No investment guarantees riches without risk. Vague white papers or anonymous teams warrant skepticism. Pressure to act quickly exploits FOMO. Legitimate opportunities allow due diligence. Community echo chambers distort reality. Dissent gets suppressed, reinforcing bubbles. Seeking diverse perspectives balances views. Economic downturns amplify crypto's vulnerabilities. Correlations with traditional markets emerge in crises. Diversification beyond crypto hedges against this, yet many treat it as isolated. Practical insights include setting clear rules, define entry and exit criteria beforehand, and stick to them amid noise. This curbs emotional overrides. Track performance honestly, journal trades to identify patterns and learn from losses without self-deception. Reality checks remind that crypto remains speculative. Regulations evolve, introducing uncertainties. Technological risks, like hacks or forks, Persist. No asset is infallible. Contrarian observation. Winners often do less. They avoid constant tinkering and focus on macro trends over micro noise. This conserves mental energy. In conclusion, losing money in crypto stems not from the market's cruelty, but from human tendencies unchecked. By understanding these dynamics, one can navigate with greater wisdom, approach with education, discipline, and realism. The path to success lies in avoiding the pitfalls that claim the majority. Remember, true opportunity rewards the prepared mind. Crypto doesn't have to be confusing. If this explanation helped, subscribe for more clear breakdowns like this. Thanks for watching.